In the world of finance, how do you get ready for a storm you can't even see coming? For decades, the answer was always to look backward. But that's changing. There's been a huge shift away from just reviewing the past to actually modeling the future. Let's break down how this is making the whole financial system a lot more stable. At its heart, the entire philosophy of how we manage loan risk has been turned on its head. We've gone from reacting to problems after the damage is already done to a model that's all about prediction, about seeing trouble on the horizon and getting ready for it before it ever arrives. It's a complete shift from playing defense to playing offense. So, the old way of doing things, it was kind of like trying to drive a car forward, but only looking in the rear view mirror. Yeah, you could see the potholes you just hit, but you had absolutely no clue what was coming up ahead. And the consequences of that old model were pretty serious. It meant banks would only account for a loss and put money aside for it after a loan had already gone bad. This whole wait-and-see thing meant that right when you're heading into a recession, the bank's reserves were often at their lowest, right when they were needed the most. Not great. And that brings us to the new way of thinking, a model that's designed from the ground up to see risk coming by preparing for what the economy might do next. It's an accounting standard, and it's called CECL. So CCL stands for Current Expected Credit Loss, and really, the name tells you everything you need to know. The key words here are expected and lifetime. From the very second a loan is created, banks now have to, look into their crystal ball and guess the total losses they expect to see over that loan's entire life. It is a huge, huge change. This new model is really built on three big pillars. First, you have to estimate those lifetime losses. Second, and this is so important, you have to use forward-looking economic forecasts, things like what unemployment or GDP are going to look like. And third, you have to break down the risk. You can't just look at everything at once. You have to see how, say, auto loans in one state might perform differently than mortgages in another. And what this all really means is that we've moved beyond simple bookkeeping. This isn't just some new accounting rule. It's the full-blown adoption of predictive analytics, right at the heart of the banking system. It's all about using massive databases to write a story about what the future holds. But, of course, a predictive engine is totally useless without any fuel. So what exactly is powering these complicated CCL models? What's the raw material that lets a bank make these incredibly sophisticated predictions? Well, trying to forecast the future takes an incredible amount of really good data. So what exactly goes into these models? It's actually a fascinating mix of past, present, and future data. The model takes in historical stuff, like how many loans went bad in the past, and it combines that with current data, like what people's credit scores look like right now. But the secret sauce is that it also layers in those forward-looking forecasts from economists, projections for unemployment and economic growth. All of these different pieces get woven together to create that final estimate. Okay, so you can't just build a super complex predictive model, press go, and then just, blindly trust it. There have to be some checks and balances. And this is where the regulators, the human gatekeepers, come in to really dig into these models and make sure the math actually adds up. And regulators have a very clear process for this. For instance, the Office of the Comptroller of the Currency, or the OCC, they have a 4-step review. First, they checked out the model's design. Then they scrutinize all its economic assumptions. Then they backtest its predictions against what really happened. And finally, they make sure the bank's board is on the hook for all of it. So we have the model, we have the data, we have the oversight. What does this all actually mean for the bottom line? How does this new approach really change how a bank operates? And more importantly, how much cash it has to keep stashed away? This timeline really lays it all out. Before 2020, we were stuck with that reactive incurred loss model. Then the big switch to CCL started in 2020, and that was a massive change. And where we are today is a world of proactive reserves, capital that's set aside right now for losses that might not even happen for years. And at the end of the day, the whole point is to make the entire system more resilient. By forcing banks to look ahead and prepare for the downturns they expect are coming, the goal is a financial system that's just better prepared for whatever the economy decides to throw at it. As we start to wrap this up, it's really important to see this as more than just a bunch of rules. It's a totally new way of telling a story. It's about taking millions and millions of data points and turning them into a coherent narrative about risk. I think this quote from the source material just says it all perfectly. Credit loss isn't just a number, it's a narrative. It's a story, right? It's a story about the economy, about different industries, and about the financial lives of individual people. And this is the key takeaway. That final reserve number you see on a bank's balance sheet, it's not just pulled out of thin air. It is the final chapter of a massive story, a story that's built from a database that contains every single forecast, every assumption, and every piece of data the bank has. And that kind of leaves us with a really fascinating question to think about. We've just seen how this incredibly complex web of data can be woven together to tell the story of our financial future. So it really makes you wonder, what other profound predictive stories are just sitting there, hidden in the vast databases we're creating every single day, just waiting to be told?